Hey folks, welcome back to the channel. It's Liquid here. Today we're going to look at a small cap company, Dye Durham. Now, why focus on small cap companies? Because by historical standards, they're trading at a fairly cheap valuation right now compared to large caps. Also, according to O'Shaughnessy Asset Management, even though small cap stocks are generally the lowest performers as the market falls, they tend to significantly outperform when markets recover. And here's a 25 worst rolling quarter returns of small caps since 1926. The green bars represent large cap stocks and the blue bars are small cap. And you can see after a stock market correction, which small caps do fall more than large caps, the next 1 year, 3 year, 5 year, and 10-year returns are all higher for small caps by quite a large margin in all of these cases, in fact. And because stocks are in a bear market this year, so it's pretty much been a year of just chopping downwards. This is a look at the S&P 500. The beginning of the year is right here in January, and the stock market was down about 28% before this recent rally here. But maybe there's more pain to come because the bear market channel has not been broken yet, and we could see another leg down. But we do know that after a bear market, small caps tend to outperform large caps. So that's why I think this is a good time, especially going into next year, 2023, to be looking at small cap companies to slowly accumulate, especially if you have a 3-year or 5-year investment horizon or longer. So you can take advantage of the small cap outperformance factor after this bear market eventually ends. So the company I want to look at today, like I mentioned, Dye Durham, it's a Canadian company, ticker D&D on the Toronto Stock Exchange. You can also buy it over the counter in US dollars, but that one doesn't have a lot of volume, so I would just recommend this one. So everything I talk about today will be in Canadian dollars. This has a market cap of nearly $900 million, and basically D&D provides cloud-based software designed to boost efficiency and increase productivity for legal and business professionals. Dye Durham works a lot with companies in real estate, finance, and even with government agencies. They operate in Canada, the United Kingdom, Australia, and Ireland. So let's say you're operating a law firm and you have a lot of clients with their information in filing cabinets. What Dye Durham does is basically digitizes all of that. So you can basically access all of your clients' information in a cloud database instead of flipping through papers. And of course, it's also easier to search for the information that you want. So that's the service D&D provides. As the world is going more digital, there will be more demand for services like this. So lots of factors to consider before you invest in any company, but the primary factor to look at is the growth. Because if you don't have a growing company, then even if the valuation is really cheap, to me, it is not worth investing in because the upside potential will be limited. What I would rather do is find fast growing companies that are trading at reasonable valuations, or GARP investing, growth at a reasonable price. So top level, let's look at the revenue of the company and if it's growing. If I take a look at financials on Yahoo Finance, and it looks like it is growing quite nicely. The company made about $44 million in 2019, but the next year it grew that to about $65.5 million, nearly $209 million in 2021, and it more than doubled that for this year. Cost of revenue is what the company had to pay in order to generate the revenue, and this is also going up. Now, what's important is to notice the ratio between the total revenue and cost of revenue. So that will tell you the gross margin. And it looks like over time, the cost of revenue is growing faster than the actual revenue. So that's not a good sign. But after all the expenses, including operating expenses, you have your operating income, and that's been growing very well over the last few years. That's about a 100% annual growth rate, roughly. Earnings per share are pretty much non-existent with a company that is still expanding very quickly, like a small cap company. So instead, we use other metrics such as price to sales or enterprise value to sales. One thing to note is this company does take on debt to make acquisitions, which is why its interest payment is pretty high, especially over the last year. And it's been growing, as you can see, a lot since 2019. So a few kind of yellow flags to watch out for. But because of the explosive growth of this company, I think as long as management can keep its expenses within line, then this should be a very profitable investment if somebody were to invest today and wait it out for a few years. Looking at the Morningstar report, what's interesting is since its IPO, the stock has rarely gotten to this level of undervaluedness. The red line is what Morningstar thinks the fair value of the stock should be, and then the black line is the actual stock price. So a couple years ago, it was at 1.04, meaning it was about 4% overvalued. Last year, it was pretty much in line, but this year, the price to fair value is at 0.57. So that is quite undervalued, as you can see in the graph. This Morningstar report does show more history of the company. So you can see the revenue going all the way back to 2016. 2014. Now, the year-to-date number here, it's basically for the first quarter of the year. So last year, it made $209 million in revenue, and in the first quarter of this year, it's already made $120 million. And you can see the growth rate and how fast this company is expanding. Now, as I mentioned earlier, one of the risks with this company is its margin, and you can see the operating margin here is dropping. Ever since 2018, it's just been slowly declining. So D&D is getting less efficient at generating those high revenues because the cost of those revenues is getting higher each year, especially on a per revenue basis. Net income is down, which is understandable for a growing company, but at the same time, you don't want this number to accelerate towards the downside, which over the last few years it has been. It's okay if a business is currently not making a net income or a positive net income, but if a company loses more and more money each year, then this can easily get out of hand, and that would not be an investable company at that point, because eventually your revenue growth is going to slow down, so you're going to need some profits in order to be a viable investment for future investors. The good news is the company is generating free cash flow because it is still kind of a high margin business what they're doing. So last year they took in almost $70 million in free cash flow. Shares outstanding has been dilutive over the last couple of years. They managed to keep it the same at 41 million shares outstanding for a while, but over the last couple of years they added some more. So now you have that's like an 80% increase in the number of shares. And normally that would be bad, but at the same time the revenue has grown from 65 million to over 400 million this year. So that's like a 7x increase in its revenue. So I'm going to give the board members a pass on this share dilution, which is not too bad, but it is something to be aware of and also to track over time, because if this starts growing too fast, outpacing the growth of the free cash flow, then that could be a problem. Okay, so we talked about price to fair value, and this is based on the fair value that Morningstar gives it, but we can look at some other valuation metrics. This is really interesting here, and what got me interested in this stock in the first place is the price to sales was 33, and now it's dropped all the way down to 2. For a technology company trading at a 2 times price to sale, that is considered cheap, especially if it's going to grow at double digits in the foreseeable future. I think the price to sales ratio is nearing a bottom because looking at this chart, we can see it is kind of flattening out here, and the stock market index is only 1.6. So if Dye Durham is at 1.9 and it's growing much faster than the TSX composite index, then that would be a very favorable valuation for this stock. Price to cash flow is also really cheap right now, just 5.24. And this is cheap even if it was an established large cap value stock. According to Simply Wall Street, this stock is cheaper than its peers if you compare the price to sales ratio. And it's also cheap compared to Analyst forecasts. We're going to take a look at that in a moment. And it is significantly below fair value. So let's take a look at that. The current price, 1350 Canadian dollars, is 75.8% below what the fair value should be, which is $55. Now, Simply Wall Street, for some reason, tends to provide price targets at fairly high values. I'm not sure why that is, but it seems like for most stocks that I look at, their fair value is higher than what other analysts have provided as a typical consensus. So I would take this with a grain of salt, but if we take a look at the future growth of this company and also the past growth. So what's interesting is before 2021, so 2019 and 2020, the revenue, which is this blue line here for D&D, was pretty much flat. And then from 2021 to basically the middle of this year, 2022, there's just been this absolutely huge growth in revenue from $87 million per year all the way up to $474 million a year. So they did something within this year and a half that just absolutely exploded their revenue by many, many folds. And not only that, but they were also able to keep earnings relatively consistent. So it went down a little bit in early 2021. That's this green line down here, the earnings, and then it went up, and it's expected to go down a little bit now before going back into positive territory again in 2024, a year from now. From 2021 to the middle of 2022, you had this huge growth in revenue, but if we look at the stock, you would not have expected that to happen because looking at Dye Durham on TradingView, 2021 at the beginning was right here in January, and the middle of 2022 would be somewhere June or July around here. So basically between these two blue dotted lines, you had the revenue grow from 70 something million to 400 something million. And yet look what the stock has done over that time. It's basically gone in a downward direction instead of up. So not only can you buy the stock now much cheaper than it was at the beginning of 2021, but you're also getting a company that is generating much more revenue than they did before. Now, before we take a look at the technicals, just want to briefly go over the financial health of the company. Most of it is pretty good, except for, like I mentioned earlier, the debt levels, because it does take on debt to acquire other companies. There's no problem in the short term. It has $312 million, and this can cover any short term liability about twice over. But it's really the long term debts that this company has that I think a lot of investors should be concerned about, at least. So this red line represents debt, and then the blue line is equity. And right now, the debt to equity ratio is 154%. So that's gone up since last year, where it was at 76%. Now, since interest rates are higher, it just means the company has to pay more. Like those debts now cost more to service. So you really don't want to see higher levels of debt, especially when monetary policy is tightening. So I would agree with this statement here that its net debt to equity ratio is considered high. And I think that's one of the reasons why the stock is right now trading at 1350 and not higher. Now, technically speaking, it was at IPO going up, and then it kind of stalled, and then there was this massive push up after the 2020 recession. And as mentioned, since then, it's just been a slow decline for the stock. So it almost looks as if the trading range for the stock is somewhere around here. It likes to stay within this range, except for this one period of time where it shot up before dropping back down. You can see there's almost no volume, like around $28 to $40. I'll make that a different color. Now, unfortunately, based on this graph, technically, there's really no long-term bullish signs right now. We're still below this 21 weekly moving average. Each one of these bars represents 1 week because I'm on the weekly chart right now. But what is nice is that we have 3 bottoms here that the stock has touched, and that's going to be a major support level going forward. So if you think D&D is a company that you might be interested to invest in and you're thinking about when to get in, I think there's a few ways you can play this. The first way is to dollar cost average. We're looking at a daily chart now. So I would buy a little bit right now and buy a little bit more if the stock drops back down to this 11.75 support line, because this is basically a double bottom, a touch there and a touch here. So most likely we're going to go up higher, but if we do come down, then we'll probably touch that line again. But the reason you want a dollar cost average if you start buying the stock today is because there is a chance that the stock can fall below that support line, and we could get into even the single digits here. Fundamentally, it might not make sense, but in the short term, anything can happen with a very volatile stock. So that's kind of what I'm doing. I already have 100 shares of D&D. I think I bought it October or September at 1676. So I'm down a few dollars per share. So I'm thinking about just adding another 100 shares in here at today's price, and that's going to drop down my average cost basis a little bit and continue to build a position down here up to maybe 300 or 400 shares. Because although it's very likely based on the growth projection of this company that the stock will go up after this bear market ends, the thing is, first of all, there's uncertainty about the individual company itself, D&D, but also we don't know how long this bear market will last. The average bear market lasts less than a year, so we should already be very near the bottom of the bear market. But there is a chance that all of 2023, the stock market can stay low, especially if the economy is going into a worse situation. So I do want to control my position sizing. Now, the second way to, if you want to buy this, is to wait a little bit until the stock retests the bottom of this range, which is basically around that $11.75 level. So if it goes there, or if it goes below $12, then you can start to buy a little bit and see what it does from there, because buying it then would be better than buying it now. Of course, the downside is you would miss out if the stock just rallies from here, but that's actually very unlikely. And then the last way you can invest in this stock, it's the most safe way, but you're also going to miss out on the initial gains. So going back to the weekly chart here, what you want to do is, and you can chart this on any graphing tool, but you basically want a line here for the 21 weekly moving average, which I've set here. And all you want to do is wait for the stock to get back above the 21 weekly moving average and close an entire candle above it. And it's It's okay if it wicks through to the bottom side, but as long as the body of the candle is entirely over this blue line, then that is a longer term bullish signal that maybe the stock has bottomed. So that's not going to happen anytime soon, but it is something to watch out for. And finally, let's take a look at the analyst's ratings, and it's pretty much a strong buy all around. We have the lowest estimate at $20. The average target is about $24, so you can get a 77.5 upside if that were to happen. There's only 5 analysts covering this stock because it is a smaller company. Of course, analyst ratings aren't everything, but that is good to see that there is a nice consensus among all of them that they are bullish on this stock. The Bank of Canada is expected to increase interest rates again next week. That would be for the December BOC interest rate announcement. I am expecting them to go 25 bips this time, and next year we're going to start seeing interest rate declines, and that will be a really positive thing for growth companies like DND. So it's hard to time the bottom for a stock like this. But instead, what I'd like to do is look at the macro landscape and think, where is interest rates likely going to go in the next 12 or 18 months? And then make sure the companies that I invest in can withstand an economic downturn or a recession and have confidence that they will continue to grow revenue, profits, cash flow over many years to come. So Dye Durham is overall, I think, a pretty good company. They have a lot of potential for future growth. I am keeping an eye on their operating margins to make sure that's not going to deteriorate too much into the future. Debt is another problem for this company. They have to stop taking on new debt and start to capitalize on the acquisitions that they've made. And the last thing is the growth of the number of shares outstanding. I think they should definitely taper that down. So that's why I'm not super bullish on this stock. If they're able to get those 3 risk factors in control, and I can see that management is serious about increasing current shareholder value, then I would maybe be more aggressive with my buying. But right now, I have 100 shares, as you saw. I'm probably going to add another 100 shares, but that's about it for the time being. We'll have to see how things go. So thanks a lot for watching. This video was just meant to be as an introduction to this stock if you've never heard of it before. And if you're thinking about buying this stock, you can definitely do a lot more research on your own. Good luck with your investments, and until next time.